In this session, we're going to look at the issue of connecting factors for taxation. Within international tax law, there are no formal rules that tell a state how they should go about raising taxes and from whom they should be raised. What we do find are two generally accepted principles in international tax law that are commonly used by countries around the world. These are based on international law concept of nationality jurisdiction and territoriality jurisdiction. However, from an international tax law perspective, these principles have been changed to the two approaches of using residence and source to establish a right to tax. The jurisdiction of a country will extend to its geographic limits, but something more specific is needed to establish a right to tax. A connecting factor is needed, which creates this link between the taxpayer and the state, and which allows the state to exercise their jurisdiction and impose tax. This link between the taxpayer and the state might also be referred to as a nexus. The concept of a nexus is also a norm in international tax. When I say norm, I mean a generally accepted rule within international tax, and the connecting factors are examples of a nexus. The nexus concept is about there being a sufficient connection with the state such that the person becomes taxable. What is required is a real and substantial link with the state to establish this right to tax. This has been the subject of various exam questions over the years. The idea of a nexus ties in with the two principles on international tax law that we mentioned earlier and that are widely accepted and used. It might be said that residency is an example of a personal nexus. It creates this link between the person and the state based on various factors set out by that state, but which will focus on matters such as where a person lives or where they have been incorporated, if you are considering a company. Similarly, the source principle is an example of a territorial nexus. It creates a link between the country where income or profits or gains arise and the ability of that state to impose tax. One viewpoint as to how such concepts came about takes us back to the end of the 19th century and the academic Georg von Schantz, who promoted the idea of economic allegiance. This refers to the fact that persons who are economically tied to a community through working there or operating a business there should share the responsibility that relates to that community. In other words, they should share the tax charge. We can also link this in with the benefits principle that you might come across in international tax. The idea behind these concepts is that if a person, be they an individual or a company for example, is benefiting from being a resident in a country, which might be through the provision of security, like a police force, or a good transport network, or sanitation, or the provision of educational establishments, then that person should take some responsibility by paying tax. Similarly, if a person benefits from having a source of income in a country, which means they are benefiting from that country's laws, protection of property, or from having a regular income stream from that community, or from having a thriving economic community that can help them grow their income and profits and lead to increases in the value of their assets, then such person should also share in the responsibility and pay some tax. All of these ideas have led us back to the two general principles that we find in international tax, being the connecting factors of residence and source. Typically, when a country uses the connecting factor of residency, then that country will tax the person on a worldwide basis. This means the person is taxed on their income and gains wherever they arise in the world, if that person satisfies the domestic test of residency in that country. When a country uses the source connecting factor, then a person is subject to tax on the income or profits or gains from transactions or sources arising within that country's territory. This does not require a person to be resident in that country, it just requires a person to have a source of income from there. Notably, all states around the world use the source connecting factor because no country is going to let a foreign person earn income from their state without paying some form of tax. If a country just taxes on the basis of source, for example, it does not apply worldwide taxation, and so does not tax foreign income or gains, then we say that country applies a territorial basis of taxation. There are a few countries around the world which do this. Hong Kong is a good example, and other states that use a territorial basis include Singapore, Malaysia, Costa Rica, and Panama. Within the broad umbrella of the residence and source connecting factors, we find some variations in approach. When we consider the residency connecting factor in more detail, there are various concepts that come within its category, the ideas of residency taxation, but also the use of domicile as a basis for taxation and citizenship. If we look at the connecting factor of source, we can say this encompasses the idea of the source of a particular stream of income or profits, but also the idea of where an asset is sited that gives rise to this income stream or that gives rise to a gain. This means situs can be a key part of the source concept. Let's look at the residence connecting factor in a little bit more detail. The concepts of residence, domicile, and citizenship are not the same. The rules are each different, even though we might class them together under the umbrella of the residency connecting factor. Residence refers to the place where somebody resides, so where they live on a day-to-day basis, where have their home and family, for example. In some states, there will be a detailed definition within the legislation. In other countries, there may be no formal definition. Instead, there might just be some informal statements of practice issued by the tax authority. The definitions and use will vary from country to country. Each state will have its own definition of what it means to be resident for tax purposes. Domicile refers to the country that a person regards as their permanent home, somewhere they will always want to live and always want to return to, somewhere where they have a substantial connection, often family connections. Domicile and residence do not necessarily coincide. A person might have a domicile in, say, France, because that is where they were born, that is where their family is based, and that is where they hope to return to for retirement. However, they may be living and working in Germany for 2 or 3 years, or they may be living in England for 2 or 3 years. They will be tax resident in those countries by living there. However, their domicile would still be in France. Some countries have made use of this by giving certain tax benefits to persons who have a foreign domicile. Citizenship as a concept is closer to the nationality idea. Essentially, it will be based on a person's passport. Whilst we class it as being part of the umbrella connecting factor of residency, strictly speaking, it could be a connecting factor of its own. However, only 2 countries actually use citizenship as a basis for taxation, the United States and Eritrea. Taking the United States, they will tax residents, so people who live in the US or who have a green card, regardless of their nationality. But in addition, the United States also taxes its citizens regardless of where they live. The source connecting factor encompasses the idea of the country of source for income or profits, which is the place where such income or profits are generated, which would be the origin of those profits. So the place where they arise, for example, this might be the place where a business operates, or the place which is the source of an interest payment. Whereas situs refers to the place where an asset is based or located. Typically, situs relates to tangible assets and refers to their physical location. For example, a property is sited in the country where the property is actually based, where it has been built. If rental income is earned on that property, we tend to find it is treated as arising in the same country where the property is sited. In this slide, we look at some of the issues that might arise when you consider the interaction of these connecting factors. In my example, Lisa lives and works in France. That means she is a tax resident in France. Therefore, France will tax Lisa on all her income on a worldwide basis, wherever it arises in the world. Lisa still owns a flat in London that she rents out. She receives rental income from the UK. However, as far as the UK is concerned, the London flat is a source of UK income, and the UK will impose withholding tax on the gross rental payments. What this means is that Lisa will suffer UK tax on the rental income on her London flat, and she will also suffer French tax on that income on the basis she is resident in France, and thus France will tax her on all her worldwide income. This provides an illustration of some of the issues that can arise when the connecting factors interact with each other. For example, there might be conflicting definitions in 2 different states. It could be that 2 states each claim a taxpayer is resident in their country. This could happen because countries have their own domestic law definition of what it means to be resident. Each state would therefore impose tax on the taxpayer on a worldwide basis. The problem, of course, is that 2 countries are doing this at the same time on the same income. Alternatively, there could be different connecting factors applying in 2 states. This was our example of Lisa, who has rental income from London but lives in France, One country is imposing tax on the taxpayer on the basis of residency, and the other country is taxing them on the basis of source. In both instances, the interaction of the connecting factors has led to double taxation. But thankfully, there is a way to resolve the double tax issue by using double tax relief, which can be offered by the state of residence either on the basis of a double tax treaty or unilaterally through their domestic law provisions. We will look at this problem in more detail in another session. That ends this session on connecting factors. Thank you.